You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
This is the Options Industry Council's Wide World of Options. Before we start today's show, listeners should know that options involve risk and are not suitable for all investors. Individuals should not enter into an options transaction until they have read and understood the disclosure document, characteristics and risks of standardized options, available by visiting the OCC.com or by contacting your broker, any exchange on which options are traded, or the Options Clearing Corporation at 125 South Franklin Street, number 1200, Chicago, Illinois, 60606. The Options Industry Council is an industry resource provided by the Options Clearing Corporation, collectively OCC. Any strategies discussed are strictly for illustrative and educational purposes only and are not to be construed as an endorsement or solicitation to buy or sell securities. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options, and the Wide World of Options radio show is one of several resources investors can utilize to learn more about options. Other resources OIC offers include webinars, articles, and self-guided options-related coursework. For more information, check out www.optionseducation.org. Now, here's your host, Mark Benzaquen.
Hello, everyone, and welcome to another episode of OIC's Wide World of Options. My name is Mark Benzaquen, and joining me once again in the studio today is my colleague, Mat Cashman, a 25-year options veteran with roles ranging from market maker to risk and portfolio manager, among others, as well as a fellow options instructor here at OIC. Matt, welcome back.
Thank you for having me. It's always a pleasure to be here. It's good to see you again.
Well, thanks, Matt. Always good to see you. And Matt, as you know, much of our content here at OIC is tailored to beginning to intermediate investors and not much geared specifically towards those with a deeper understanding of options who might be looking for more advanced and complex content. With that being said, I understand that you're going to be presenting 2 webinars this month with these advanced investors in mind, and I was hoping you might share some of those highlights that you'll be covering with us here today. Sound good?
Absolutely. That sounds great. I'm excited to do some deep dives into some more complex material.
Excellent. So let's go ahead and get started. Matt, from what I understand, your webinars are going to be exploring the concepts of options skew and relative value, 2 concepts that at the root evolved from implied volatility, if I'm not mistaken. So let's go ahead and start there. What is implied volatility and why should investors care?
That is a really great question. Implied volatility is basically the largest main input into an options price, and specifically, it has to do with an options price on the extrinsic value side of its valuation. What that means is that implied volatility from the market making side of things, which is a lot of times where the valuation from the options comes from, is the biggest knob or dial you can turn on your model that will affect option prices immediately. And what implied volatility really is the market's best guess as to what the actual movement that is forecasted for the time frame of that option is going to be for the underlying.
Okay, so to summarize, what you're saying is that implied volatility is basically the market's way to gauge potential underlying stock price movement and quantifies those expectations through the price of the option.
Absolutely.
So if implied volatility is increasing, for example, the market is saying that they're expecting a wider range of potential stock prices throughout the life of that option. But it's important to remember that those prices, that future range, can actually be higher or lower than its current stock price, that the implied volatility doesn't imply direction, it just implies a wider range of potential prices. Excellent. That I understand. Thank you. So let's go ahead and take that concept a bit further and answer for me this question. Are all options equally priced? Meaning, for example, our 10% out of the money puts priced similarly to 10% out of the money calls, for example?
The short answer to that is no, that they're not always priced that way. They can be, obviously, but like any good or service, options pricing is based on supply and demand. And so the more investors are seeking out options, generally speaking, if the supply of those options stays relatively similar and the demand goes up, the price is going to be higher. That's generally how they work. This dynamic was really evident in some of the moves of the late 80s when the market crashed and investors really started to buy puts for protection, and the actual supply of those puts was not going up at the same rate that the demand was, and thus the prices of those puts was going up relative to calls. Now, this is where the idea of skew really comes from, is that you have these asymmetric moves that the price history of an underlying has kind of built into the history of the product itself. And so when you're talking about option skew, it's essentially the measure of implied volatility for options with different strike prices, but the same expiration date. And it shows how the market perceives risk for various price levels.
So option skew, what you're saying, it's really all about how the market views risk at various strike prices. You had mentioned tail risk. Can you explain what you mean by that?
Yeah, so tail risk kind of colloquially is that the expectation, or maybe more appropriately, the non-expectation of a low probability event actually taking place. And so when you think about the shape of a regular price distribution, the areas on the left and the right side of the price distribution where it's lowest is where those tail risks generally occur. And like I said, colloquially, some people like to put a number on it as far as standard deviations that would like actually create a tail risk event. Some people think that a move of more than 3 standard deviations can sometimes be, considered a tail risk event. But let's say that it's between, 3 and 5 standard deviations away from the mean. And what that really means is that you're really trying to price, when you're pricing tail options, or those options that exist on either side of that price distribution, that's where theoretically that tail risk exists, where if the underlying were to move, say, 5 standard deviations to the downside or 5 standard deviations to the upside, those options that are in those directions would be those kind of tail risk options that people would price in that way.
Okay, excellent, Matt. Thank you. For those listeners that may not understand Matt's conversation about standard deviations and price distributions, this is a more complex topic. So if you're unfamiliar with some of those concepts that Matt and I are talking about, you might want to check out our OCC learning course on implied volatility and the other on pricing models, where these concepts are detailed a little bit more thoroughly. So Matt, again, thanks for that explanation about tail risk. Let's get back to skew. You mentioned that it first became apparent or prevalent maybe back in the late 80s or so. Has it evolved since, or is it, as it's always been?
That's a really good question, and I think it speaks to the idea that skew is a concept that's been around for a really long time, but it gained a lot more prominence after people saw these moves that happened in the late 80s, for instance, during the crash in 87 and in the 90s, especially towards the end of the dot-com bubble. You're seeing these moves that happen to the downside that started to be, like I said before, built into kind of the price history of how people viewed that underlying. And so as academics began to study it more closely, initially skew was relatively flat, meaning that the out-of-the-money calls and the out-of-the-money puts were priced relatively close to each other in implied volatility and price terms. But as you start to factor in the price history of the underlying, and that sometimes these moves that are drastic were happening more to the downside than they were to the upside, it stands to reason that in those situations, if you were to build in that price history into how you were to price options and the probability of those options coming into play, that those downside puts, the puts that give you protection to the downside and thus prepare you for a downside move like that, are going to be, from the perspective of supply and demand, they're going to be slightly more expensive. And so that's where this downside put skew shape comes from in things like individual equities and indexes. In the United States, generally, they have what we call downside put skew or positive put skew downside.
Okay, excellent. Thank you. Is there such a thing as, well, I guess it wouldn't be upside protection, but is there skew that reflects, say, an upside bias in the underlying?
Absolutely. And you'll see that. What the term that I generally use to describe that is called demand skew. And the reason why it's called demand skew is because that skew, which, just like you said, would be kind of tilted the opposite direction. It would be the exact opposite, where the calls would be priced higher in implied volatility terms. The out-of-the-money calls would be priced higher in implied volatility terms than the downside puts. Why would that happen? Well, sometimes it happens in things like commodities, where demand is the real root of how these things get priced from a forward curve and from a forward, from how the actual futures are priced. Think about this. When soybeans are priced on an underlying basis, there's a limited amount of soybeans in the crop in the United States. And that number is known by the USDA and people who go out and do crop surveys. They can tell you how big the crop is. Well, what happens if in August it starts 106 degrees every day in Illinois, where most of the soybeans are, the close to the Mississippi River, where most of the soybeans are grown, and it doesn't rain for 3 weeks? Well, those crops are going to die, and that actual crop is going to be much smaller than it actually was forecasted to be. However, the demand for soybeans stays the same. People don't stop eating edamame when they're out having sushi, right? When all of a sudden it's 106 degrees and it doesn't rain in Illinois. The demand for soybeans stays the same. The supply goes down. But what happens in that environment? It's a demand skew. Things get really frothy to the upside as far as price is concerned. The way that I like to describe this is that equities and indexes generally crash to the downside and stair-step up in price terms. On the other side of that, you have commodities like soybeans or wheat or crude oil. Crude is a little bit different because it can kind of move in both directions very drastically. But let's call the agricultural commodities a good place for this to be, where the actual crashes come from the upside price movement. They crash up and stair-step down in price.
Well, that's fascinating, Matt. Thank you. It's amazing how market dynamics can change over the years, or in the case of commodities, as you had mentioned, change season by season. Very interesting stuff. Thank you. Now I want to shift gears and let's take a bit of a deeper dive into implied volatility and put the two together. So how does implied volatility tie into option skew, and why is it crucial that option traders understand it?
That's another good question, Mark. Implied volatility is really, like I explained before, a crucial component of option pricing. And as I explained, it's really the market's estimate of how much a stock or index might move in the future over the course of the lifetime of that option. So implied volatility, however, can also vary quite a bit across different strike prices within the same month. And this is where it connects and actually creates option skew. So traders use implied volatility to assess the relative value of options, and it's a way to be able to look at what one option might be worth relative to another option, because it's a very common number that they actually share. They're both of their prices would be priced in terms of implied volatility. And in that case, sometimes a high implied volatility might make selling options more attractive to some people, while a low implied volatility might signal to some people that it would be time to buy options as far as the way that they look at the market.
So what you're saying, implied volatility and option skew go hand in hand. So it's really about understanding the market expectations and using that to make informed trading decisions. Now, you just mentioned relative value. What do you mean by that? Relative to what?
Relative value is a really interesting concept, and it's something that can sometimes be hard to explain to people. But what I like to do is talk about the fact that relative value at its heart is a very simple concept. And what it means is that it is essentially just thinking about what something is worth in terms of something else, some other asset. So when you think about it in terms of trading, what I like to tell people is you're trading relative value even when you don't know that you are. And the reason why is because your account is priced in US dollars. And so every trade that you make is based on what you think that option premium or what the market thinks the option premium is for that, but it's priced in dollars. And so you're making these trades on a relative value basis because your account is priced in dollars. And so that's your actual relative value. You are pricing options based in dollars. Now, if you take that concept and you extract it out a little bit, what you end up with is the idea that you can not only price things relative to dollars, but you can price things relative to other assets. And then if you take it one step further, you can price two option implied volatilities relative to each other. So you can look at something and say, what is the relative value of the SPX 30-day option relative to the NDX 30-day option, or some index versus some index, some currency versus some currency. And what you're really doing is you're taking these two implied volatilities. When you're talking about it in option terms, you're taking these two implied volatilities and you're expressing one of them in terms of the other one. So it can get a little bit wonky when you start to think about it in those terms, because you're dealing with two moving variables, but it's important to have a framework with which you can evaluate what those things are worth and how to think about them. This is one of those things that we're going to get into in the webinar that's going to be coming up on relative value. You might want to take a look at that because it's going to be a much deeper dive into that concept. But like I said, at its heart, relative value is expressing the value of one thing in terms of another thing.
Okay, yeah, very powerful concept indeed. It really highlights how understanding skew and relative value can potentially give traders an edge in the market. And as you had mentioned, with our discussion today is a very high-level overview of these concepts. But with your presentation this month, listeners will be sure to want to tune in, because you are going to be taking, as you said, a much more in-depth discussion of these two concepts. So thank you for that explanation. And before we wrap up today's episode, do you have any final thoughts for option skew analysis?
Yeah, absolutely. Studying the historical data for what you're looking at is always going to give you the best frame of reference for what's happening immediately in front of you. And it's going to give you a sense of how, for these purposes, I would say studying historical skew data for whatever product you're looking at. Maybe it's a stock, maybe it's an index, but knowing where historical skew has lived, relatively speaking, in the past can really color your idea of what you're looking at immediately in front of you and give you a great historical framework from which to evaluate what's happening right now, because options are very dynamic. Pricing is very dynamic, and it just gives you a frame of reference historically for where things could be relative to where they are now.
Kind of like the old saying that you can't really get to where you want to go unless you fully understood where you've already been.
Absolutely.
I like that. Looking at what had happened in the past might give you some insight as to what might be right down the road. So excellent point, Matt. Thank you so much. Ladies and gentlemen, option skew, implied volatility, and relative value option trading. All critical concepts for anyone looking to take their options trading to the next level. But before I let you go, Matt, I want to continue our tradition of allowing our listeners to get to know us, the OIC instructors, on a more personal level. So outside of your work experience, which is extensive, we all know, what might our listeners want to know about Mat Cashman outside of options? For instance, I know that you're an avid music lover. Why don't you tell us about that?
Interesting. Thank you for that segue. So I kind of fell backwards into options trading in the late 90s. But before that, I actually studied music and philosophy at Northwestern on the north side of Chicago. So I have 2 degrees, one in music performance, saxophone performance, and one in philosophy. And I've been a saxophone player my entire life. And I went to school to study music and then was an actual working gigging musician out of school before I started trading options. And I still play now, although not as much as when I was gigging professionally, but I think that there's a lot of connected ideas behind the way music works and behind the math that underlies these option contracts. And it was always part of what was fascinating to me about the options world, is that a lot of times when I was standing, especially in a pit, that my ears were sometimes my best asset, because a market that is rallying sometimes makes a different sound from the pit than a market that is selling off. And it's an interesting way to kind of meld those 2 ideas. And it's something that I learned probably halfway through my trading career as a pit trader, that markets sound different when they're doing different things, especially when you're on a floor. And that's because people yell differently when they're scared than they yell when they're not scared. And so that was one of those things that I always thought was interesting. And one way that I was able to, as traders, we're always looking for what is our edge relative to other people. And so I started focusing sometimes on those kinds of things because it was something that not very many people had in the industry. I know that you are a drummer, right? And so you have a little bit of that as well.
I do, although it's interesting when you equate music and options, the math aspect of it, because I certainly have heard that in the past, that music is just another form of math. Myself being a drummer, there's a lot of people would joke that I'm not a musician and I'm simply a drummer instead, which sadly I tend to agree with. So any of you listeners out there that are drummers, I apologize for the slight. Certainly your experience and knowledge of music is no reflection of my lack of understanding. So that being said, Matt, great stuff. As a fellow music lover and avid musician, always nice to hear from and work with fellow musicians. So certainly thanks for sharing that with us, and thanks for joining us today.
Yeah, absolutely. It was great to be here. I'm always happy to sit down and talk options with you, Mark, and anyone on the OIC and OCC team.
Well, and thank you for that. We always welcome it. And thank you to our listeners and supporters out there. Be sure to register and tune in for Matt's 2 upcoming OIC webinar events in October. Listeners can register for Matt's presentations as well as all upcoming OIC events via the events section of our OIC website, optionseducation.org. And as always, please feel free to send your questions via email at options@theocc.com or live chat with us on our website. Thanks again to all those listening, and we'll be talking with you again very soon. Take care, everyone.
You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you've heard on today's show, email options@theocc.com or visit www.optionseducation.org and chat with OIC's Investor Education team. Interested in connecting with OIC on social media? Subscribe to the OIC YouTube channel, like them on Facebook, follow them on Twitter at options.edu, and follow their page on LinkedIn. Thanks for listening, and be sure to tune in to the next episode of Wide World of Options.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.